Most people are misreading XRP right now. Ripple is now connected to financial flows measured in the trillions, while actual on-chain activity is still a tiny fraction of that system. In the next few minutes, we'll break down the 16 trillion figure, the latest RLUSD and XRP ledger data, and what it actually tells us about institutional adoption and what it does not tell us about XRP. Start with the number roughly 16 trillion in annual transaction flows associated with businesses Ripple now owns or operates around. That does not mean XRP is processing 16 trillion. The distinction is critical. Ripple Prime gives the company institutional prime brokerage infrastructure. G Treasury gives it corporate treasury management infrastructure. RLUSD adds a digital dollar, while the XRP ledger provides the underlying blockchain rails. Put those pieces together, and the interesting question isn't whether 16 trillion suddenly moves onto XRP. It's what happens if even a small percentage of those existing financial flows begins moving onto blockchain infrastructure, and whether XRP actually captures part of that activity. Ladies and gentlemen, if you want the satellite perspective on XRP and crypto and want to cut through the daily chaos and noise, subscribe to the channel. I break it down simply so you can see what actually matters in the markets. And thank you always to everyone who likes and shares each of our videos. These two things really do help out the channel. Why the acquisition matters. Now, this is what most people miss. Ripple isn't simply buying companies because acquisitions look good on a press release. Nah, it's building a stack. Think about the pieces. Ripple Prime gives institutional clients access to prime brokerage infrastructure. G Treasury gives corporations treasury management infrastructure. RLUSD gives Ripple a dollar-denominated digital asset. The XRP ledger provides the blockchain infrastructure, and XRP potentially provides a bridge asset and liquidity layer in certain transactions. Those are different pieces of the same puzzle, and this is where the story gets much more interesting than a simple XRP price prediction. Imagine a multinational corporation that has a dollar sitting in one jurisdiction, euros somewhere else, other currencies elsewhere. It needs liquidity, it needs collateral, it needs settlement. Traditionally, all of this happens through layers of banks, brokers, custodian, payment networks, and correspondent relationships. The blockchain itself and thesis is that some of those layers can become software. Faster, more transparent, available around the clock, and potentially cheaper. That doesn't mean every transaction suddenly moves on-chain. It means the architecture of the financial system can gradually change. But here's where it gets interesting. Ripple is no longer just selling the idea of blockchain. It is increasingly selling financial infrastructure. There is an important historical parallel here. In the 19th century, the telegraph transformed finance because information could suddenly travel faster than physical transportation. For the telegraph, financial information moved at the speed of people, ships, and trains. Then the message could cross enormous distances almost instantly. Financial markets changed. Prices could synchronize faster. Orders could travel faster. And institutions could coordinate across geography in ways that had previously been impossible. The lesson isn't that blockchain is the new telegraph. No, that's too simplistic. The lesson is that the financial systems change when the speed and architecture of information change. Today, money and financial assets still often move through systems designed around institutions and processes built decades ago. Blockchain asks whether settlement itself can become programmable. That is a much bigger proposition. And this is why institutions aren't necessarily interested in crypto because they suddenly become ideological believers. No. They're interested because faster settlement can solve expensive problems. Let this sink in, marinate on that. Here's the 30% question. Let's address one of the biggest claims in this entire story. The idea that roughly 30% of relevant financial volume could migrate onto blockchain rails over a 5-year period. This is where we need to be extremely precise. A target or aspiration is not the same thing as a forecast, and a forecast is not the same thing as actual adoption. Those are three completely different things. Someone says 30% could eventually move onto blockchain infrastructure. That does not mean 30% will automatically flow through XRP. It doesn't mean XRP captures 30% of global payments, and it certainly doesn't tell us what XRP's price will be. But mathematically, it does demonstrate why small changes in settlement architecture can become enormous. Take 16 trillion as a reference point. 1% of 16 trillion is 160 billion. 5% is 800 billion. 10% is 1.6 trillion. 30% would be 4.8 trillion. Those numbers are enormous. Let them sink in, write them down. But here's the key. Volume is not the same thing as value accrual. A blockchain can process huge amounts of transactions without the native token capturing an equivalent amount of economic value. That's one of the most important distinctions investors need to understand here. See, XRP is not the same as Ripple. This is the point where crypto discussions often become confused. Ripple is a company. XRP is a digital asset. The XRP ledger is a blockchain network. RLUSD is Ripple's dollar-backed stablecoin. Those things interact, but they are not interchangeable. Write this down. Understand this. Marinate on this. If Ripple processes $1 trillion through a treasury platform, that doesn't automatically mean $1 trillion of XRP was bought. If RLUSD settles a transaction, that doesn't automatically mean XRP captured the entire transaction value. And if a company uses the XRP ledger, that doesn't necessarily mean it holds billions of dollars of XRP. This distinction doesn't make the XRP thesis weaker. It makes the analysis more honest. The real investment question becomes, which parts of this growing infrastructure actually create demand for XRP? I want to hear you in the comments what you think, okay? That could come through liquidity, bridge transactions, collateral, market making, institutional settlement, or other uses that develop as the ecosystem matures. But those mechanisms have to be demonstrated. They can't simply be assumed. And that brings us to the data, baby, because Q2 gave us something much more useful than another partnership announcement. It gave us measurable on-chain activity, the on-chain data, Q2. See, according to reporting on Blockworks Q2 2026 XRP ledger report, stablecoin transfers volume on the XRP ledger reached roughly 10 billion, up over 207% quarter over quarter. That's massive. RLUSD accounted for approximately 9 billion of that volume, around 90%. That's significant, not because 10 billion is comparable to global financial markets. It isn't, but because growth is happening from a relatively small base. And that's how infrastructure adoption normally looks. Small, then measurable, then increasingly useful, then potentially exponential. Ladies and gentlemen, that same report indicated stable coins on the XRP ledger climbed to roughly 825.5 million, while RLUSD reached approximately 676.9 million on the ledger, while RLUSD itself showing substantial quarter-over-quarter growth. These numbers are massive, ladies and gentlemen, and you write them down and you look at it on paper. It tells a story. So now we have something concrete. Not imagine what blockchain could do, but here's what happened on the ledger. That's an important transition. And this is where the story becomes less about speculation and more about infrastructure. RLUSD, the quiet piece of this puzzle. See, RLUSD may actually be one of the most important pieces of this entire strategy. Why? Because institutions don't necessarily need another volatile asset. They need dollars, digital dollars, settlement dollars, collateral, liquidity, treasury instruments. Ripple describes RLUSD as a dollar-denominated stablecoin backed by segregated reserves and available across the XRP ledger and Ethereum with settlement designed to occur in seconds. That is a very different pitch from buy this token because numbers go up. The pitch becomes use a regulated digital dollar to move value. That is a much easier for a corporate treasury department to understand, and potentially much easier for regulators to structure rules around. Now, this is what most people miss. Stablecoins may be the bridge between traditional finance and blockchain, not because everyone suddenly wants crypto now, but because businesses already want dollars. The blockchain simply changes how those dollars move. Let's talk about the Eurodollar system. See, to understand why this matters, look back at the rise of the Eurodollar market after World War II. Dollar deposits began developing outside the United States, creating a massive offshore dollar ecosystem that wasn't simply identical to the domestic banking system. The important lesson is that money doesn't always respect the geographic boundaries of the institutions that created it. Capital finds efficient infrastructure. If dollars can move more efficiently through a new financial architecture, institutions can adapt. Today, stablecoins are creating another version of that question. Where should digital dollars live? Who should use them? Who regulates them? What reserves back them? How can institutions use them? How do they move across borders? The answer to those questions could shape financial infrastructure for decades. This is why the Genius Act matters, not because a law automatically makes XRP the anointed one valuable, but because regulatory clarity can determine which dollar digitally infrastructure survives. Let's talk about the Genius Act and Treasury. The U.S. regulatory environment has been moving quickly. The Genius Act created a federal framework for payment stablecoins, and Treasury has been actively developing, implementing regulation. In April, Treasury and its agencies proposed rules addressing anti-money laundering and sanctions compliance requirements for permitted payment stablecoin issuers. And in June, Treasury, FinCEN, the OCC, Federal Reserve, FDIC, and NCUA proposed additional rules dealing with customer identification requirements for permitted payment stablecoin issuers. This is important. Write this down. Let this sink in and marinate on that, because the regulatory conversation is no longer simply, should stablecoins exist? The conversation is increasingly, how should stablecoins operate inside the financial system? That's a structural change. But don't confuse regulatory progress with regulatory certainty. Rules can change. Agencies can disagree. Congress can amend legislation. Administrations can change priorities. And competitors can build better products. So investors need to separate the signal from the noise. Short-term noise, long-term structure. Pay attention to what's quiet, ladies and gentlemen. Here's the first historical analogy for today. Think of the blockchain infrastructure like a railroad network. The railroad isn't valuable because trains exist. It's valuable because economic activity starts reorganizing around the network. Factories move closer to rail lines. Cities grow around stations. Warehouses appear along routes. Businesses change their logistics. The network becomes more valuable as more economic activity depends on it. That's the potential blockchain thesis. The XRP ledger doesn't need to replace the entire financial system overnight. It needs to become useful enough that institutions begin building around it. And that's exactly why Ripple's acquisitions matter. Ripple is trying to control more of the financial stack around the rails. Prime brokerage, treasury management, stablecoin infrastructure, payments, settlement. The more pieces connect, the greater the possibility that the blockchain becomes embedded in actual financial workflows. But, and this is important, the railroad analogy also teaches something uncomfortable. Not every railroad company won. Some built enormous infrastructure and still failed. Infrastructure adoption does not guarantee shareholder returns. Competition matters. Acquisition matters. Capital matters. Regulation matters. And in crypto, token economics matter too. Here's the competition. See, Ripple is not operating in a vacuum. JP Morgan has been developing blockchain-based financial infrastructure. SWIFT continues modernizing cross-border payments. Banks are experimenting with tokenized deposits. Stablecoin issuers are competing for liquidity. Ethereum remains a major settlement environment. Other blockchains are targeting institutional markets. So the question isn't, will blockchain become part of finance? No. That is increasingly difficult to dismiss. The real question is, which networks become the dominant infrastructure? And that's a much harder competition. Ripple needs customers. It needs volume. It needs liquidity. It needs regulators. It needs developers. And ultimately, it needs institutions to choose its infrastructure over alternatives. That's why the acquisition strategy is fascinating. Ripple isn't just trying to build technology. It's trying to build distribution. Because in finance, technology without distribution can lose. Here's another analogy. Imagine two telephone networks. One has amazing technology, but almost nobody connected to it. The other has millions of customers, businesses, banks, and institutions already connected. Which network has more strategic value? That's the network effect problem. Financial infrastructure works similarly. The more institutions that use a network, the more useful the network becomes. And that's why Ripple's acquisition can matter, even if they don't immediately produce enormous XRP demand. They potentially bring institutional relationships closer to Ripple's broader ecosystem. That doesn't guarantee XRP usage, but it creates the possibility. And possibility is where investors need to stop and ask, the next question. What evidence would prove that possibility is becoming reality? I want to hear in the comments, what do you think? That's where quarterly reports become much more important than social media predictions. Watch stablecoin volume. Watch XRP ledger transaction activity. Watch institutional products. Watch tokenized assets. Watch treasury adoption. Watch whether XRP itself is actually being used as liquidity infrastructure, because those are the breadcrumbs. What would 1% actually mean? Let's revisit the famous 1% calculation. Write this down. If $16 trillion represents relevant annual financial flows, then 1% equals approximately $160 billion. Well, remember, that does not mean $160 billion of XRP must be purchased. It means $160 billion of transaction flow would be represented by the hypothetical migration. Those are very different things. A single dollar can circulate many times. A payment network can process enormous volume without needing an equivalent amount of assets permanently sitting inside the system. So the simplistic argument, 160 billion of volume means 160 billion of XRP demand, doesn't work. The more sophisticated argument is, if institutional activity increases on-chain liquidity requirements, may increase. Market makers may need inventory. Settlement providers may use digital assets. Collateral requirements may evolve. Bridge liquidity may become more important. And if XRP is selected for those functions, then the economic relationship between institutional volume and XRP demand could become meaningful. Could, not guaranteed. That's the word investors should remember. But here's the real risk. Now, here's the part most bullish videos skip. The biggest risk isn't necessarily whether blockchain technology works. It works. The XRP ledger works. Stablecoins work. Tokenization works. The harder question is whether institutions adopt a particular network at sufficient scale. That's a sales problem, a regulatory problem, a competitive problem, and a timeline problem. A bank may love the technology and still take 3 years to integrate it. A multinational corporation may test stablecoins but keep most treasury operations traditional. A regulator may approve an architecture and then impose additional requirements. A competitor may offer a better product. So the adoption curve could be much slower than the most optimistic projections suggest. And this is where price becomes dangerous, because markets can price the future long before the future arrives. Price is reacting, systems evolving. Those are not always the same thing. What to nudge next? So what should investors actually monitor? First, RLUSD growth, not just market capitalization, actual transaction activity. Second, XRP ledger institutional usage, and corporations and financial institutions actually using the network. Third, XRP's role. Is XRP being used as a liquidity asset bridge, asset collateral, or settlement asset? That's very important. Or is most of the growth happening through stablecoins without meaningful XRP demand? Fourth, Ripple's acquisitions. Do Ripple Prime and G Treasury generate measurable pathways into blockchain settlement? And fifth, regulation. The stablecoin framework is developing quickly while broadening crypto market legislation still evolving. As of today, the U.S. administration is continuing to push for greater crypto regulatory clarity, including the Clarity Act, while the market is reacting to those policy developments. That matters because regulatory certainty can determine institutional participation. So here's the big picture. Let's zoom all the way back out. The XRP story isn't simply XRP is going to process 16 trillion. That's too simplistic. The bigger story is this. Ripple has accumulated pieces of financial infrastructure touching enormous pools of economic activity. It owns Ripple Prime. It owns G Treasury. It has RLUSD. It operates around the XRP ledger. And regulators are increasingly creating formal rules for stablecoins and digital financial infrastructure. Meanwhile, Q2 data showed that stablecoin activity in the XRP ledger was growing rapidly, with roughly 10 billion stablecoin transfer volume and RLUSD representing the overwhelming majority of activity. That's not proof that the XRP will dominate global finance. It isn't proof of a particular price. And it isn't proof that 30% of financial flows will migrate on-chain. But it's evidence that the infrastructure is being used. And that's the part worth watching. So here's my final takeaway. $16 trillion sounds like a price prediction. It isn't. It's a reminder of the size of the financial system Ripple is trying to connect with. 1% is not a guarantee. 30% is not a forecast. RLUSD growth is not automatic. XRP demand and regulatory progress is not permanent. But put all those pieces together and something important becomes visible. The financial system experimenting with new rails. Stable coins are becoming institutional infrastructure. Treasury management is moving toward digital settlement. Prime brokerage is becoming increasingly connected to digital assets. And Ripple is positioning itself across multiple layers of that transition. That is the thesis. Not XRP must go up, ladies and gentlemen. The thesis is if institutional finance moves meaningful onto blockchain infrastructure, which networks and companies are positioned to capture that activity. Ripple is clearly trying to make sure it's the answer. Ripple. And the XRP ledger is clearly trying to make sure that it has a seat at the table. So keep watching the numbers, not the hype. Watch the quarterly reports. Watch RLUSD. Watch stablecoin volume. Watch institutional adoption. Watch whether XRP itself becomes increasingly important to the settlement architecture, because that is where the thesis either gets stronger or falls apart. And remember, short-term noise, long-term structure. Prices reacting, systems evolving. If you want to follow the evolution before the next headline hits, subscribe to the channel, turn on notifications, and stay with me, ladies and gentlemen. Because the most important part of the story may not be what Ripple says it wants to build. It may be what the financial system actually starts using. Hope everyone's having a blessed afternoon. I want to welcome all the new members of the Patreon, the Crypto Public Desk Monthly, all the new members of the membership channel. A lot of meaningful things happening, correct? Before I get into today's epic part 2 rant, how good does it know to know what's going to happen before it happens in the market, even if it's a day, 2 days, 3 days before? We saw the U.S. come out and say the strongest sanctions ever to hit Iran. We were talking a few days ago that the United States would crush the Iranian currency. You heard it here first. We explained and went over why the world is broke and why you stay with the blockchain bonanza. Look where we're at right now. I learned, being a financial mercenary, a lot of tales of this business. I learned in the pits of the full New York Mercantile Exchange not to get caught up like sushi when people are screaming and yelling. I learned to keep my composure, that Gucci focus, that Gucci conviction, that Gucci clarity. Ladies and gentlemen, if you want to learn how to trade, you want to learn how to invest, doesn't matter where you are in your financial journey. If you want to learn how to position before the news hits and position before the market reacts, come and join the Crypto Public Desk Monthly, ladies and gentlemen. Join over 680 active traders, investors who are taking their own destiny to their own hand and want the deeper macro research. One tip from the pits pays for your entire year subscription. But I'm going to go to part 2 now, Rant, here of Rant Carnivorous. We're going to be calling this. That's what someone was calling it today. Let's go to part 2 now. So let me tell you what I think is really happening in the markets right now. Because underneath all the noise, there's a much bigger story developing, ladies and gentlemen. Yesterday, Treasury made a very interesting move. Scott Bessent announced that the Treasury would at least double the size of its long-end buyback operations, taking them from a maximum of $2 billion to at least $4 billion per operation beginning September 9th. And the market initially loved it. Gold went up, the dollar went down, Bitcoin started waking up, long-duration bonds rallied. It looked like somebody had finally stepped in and said, okay, enough. But here's the problem. Look at what's happening now. The relief is already being challenged. Yields are moving back higher. The 10 years back around 4.7%. The 30 years back around 5.2% territory. Stocks are feeling the pressure. And this is exactly why I don't think the buyback itself is the most important part of this. People are getting caught up like sushi today. The buyback is relatively small compared with the enormous treasury market and the amount of debt the government needs to finance. It doesn't eliminate the deficit. It doesn't eliminate treasury supply. It doesn't eliminate inflation. It doesn't eliminate geopolitical risk. It doesn't eliminate enormous amounts of capital being sucked into AI and corporate debt issuance. And it doesn't solve Japan. And it certainly doesn't solve the energy situation. So what is it? It's a signal. And I think that signal is far more important than actual dollars being spent. Treasury is basically telling the market, we are not willing to simply sit here and watch the long end of the treasury curve spiral out of control. And if you watched our video 2 days ago when I went on that carnivorous rant about what's happening around the world and their bond markets, you were in the know before this move happened. That's all that matters as financial mercenaries, is to win. And that is a very important line to cross, because we spent months watching pressure build in the long end. It's going down. I want to sell all my XRP. Oh my God, you made a video. Yeah. You feel better today, right? Feeling Gucci today. Don't lose the Gucci-ness. So you've got some enormous treasury issuance. You've got deficits that aren't going away. You got corporations issuing debt at an incredible pace. You got AI-related financing demanding enormous amounts of capital. You got Japan dealing with its own problems, potentially changing the demand dynamics of U.S. Treasury. Ladies and gentlemen, it's one thing to report the news. It's another to make money off it before it happens. That's a financial mercenary, not a commentator. That's a player in the markets. A mercenary doing what he's got to do to make that money every day. His daily, monthly, quarterly nut. That's the difference that you learn on the floor of the New York Mercantile Exchange in the pits. When I was sitting there at 15 years old, it was like being sent to the mines. But on top of all that, you got inflation that refuses to completely disappear. So you got more supply. You got questions about who's going to buy that supply, and you got an inflation problem sitting underneath the entire thing. That is a horrible combination for long-duration bonds. And now you potentially got another problem coming from energy. This is the part I think people are underestimating. That I'm telling everyone that retains any capacity. Everybody keeps talking about crude oil. But the problem may not ultimately be the crude. The problem could be refining. It's diesel. It's jet fuel. It's gasoline. It's the downstream products that actually keep the global economy moving. Shipping needs fuel. Trucking needs fuel. Airlines need fuel. Architecture and agriculture needs fuel. You can't build without fuel. Construction needs fuel. Manufacturing needs fuel. So if the bottleneck moves from extracting crude to actually refining that crude into usable products, you can't just wave a magic wand and make the problem disappear. Ladies and gentlemen, it's the same problem with the silver market stateside. We got the concentrate coming from Venezuela. There's no domestic refining capabilities. Nobody's been building refineries in stateside for years. It just didn't pay to build refineries here. They were built overseas. We've been building them, for 20 plus years in Indonesia. Makes sense over there, but stateside, no. So there's a lag time. You can't just wave your hand and say, refinery capacity, go. It's not like Star Trek. Scotty, give me warp power. Doesn't work that way. And that's why the Iranian situation matters so much. Because if the energy situation deteriorates further, you could get another inflation impulse at exactly the wrong time. And look at what's happening around the world, ladies and gentlemen. European gas prices have been rising. German yields are moving higher. We just had someone come back from a family vacation in Poland. What they were paying for petrol was nuts. Oh, my Lord. And U.S. Treasury yields are coming under renewed pressure. So suddenly you got inflation concerns colliding with an already fragile rates market. And that's where the Treasury buyback becomes fascinating, because I don't think Treasury suddenly solved anything. This is a Band-Aid, ladies and gentlemen. Write this down. This is a Band-Aid, but it's a Band-Aid that tells you something very important. They're worried. They're worried about what happens if the long end keeps moving higher. We've been going over the long end for months. It's how you finance everything. Because higher long end term yields don't just hurt bond investors. They hit mortgages, corporate borrowing, they hit government interest costs, they hit financial conditions, and they produce some of the most spectacular trading opportunities. And if you want to know what we're going to be trading off of this, come and join the Crypto Public Desk Monthly, baby. Hunt with the pack. One tip from the pit pays for everything, your entire year subscription. Because eventually, they're going to hit the economy. And this is where I think the next phase becomes incredibly interesting. Because if this intervention doesn't work permanently, what happens next? That's the question I want you to think about. I'm not saying QE is coming tomorrow. I'm not saying the Fed has already decided to implement yield curve control. I'm saying if the pressure continues to build, the policy responses could become progressively more aggressive. Operation Printed to Win has begun, ladies and gentlemen. Begun. And this is where I think the yield curve control angle gets really interesting. Because imagine the market keeps pushing. Treasury keeps issuing debt. Investors demand higher yields. Inflation stays sticky. The long end keeps selling off. At some point, policymakers have a choice. They can continue allowing yields to rise, or they can try to put a ceiling on those yields. That's essentially where yield curve control comes into the conversation. I'm not saying we're there today. I'm saying that if this pressure becomes severe enough, YCC becomes one of the tools policymakers could eventually be forced to consider use. And to us, that is the throttle for Operation Predict to Win It. And we've been talking about this for a very long time. And that's a completely different ballgame. Because once you start telling the market that a particular treasury yield cannot rise beyond a certain level, you have to be willing to defend that ceiling. And how do you defend it? You buy the bonds. And if the Federal Reserve is the entity doing the buying, you're potentially talking about creating new reserves and expanding the balance sheet. That's where YCC can eventually bleed into QE. So think about the progression. First, you get the Treasury buyback. Write this down. I can't believe I'm giving this away for free. Then you get increasingly aggressive attempts to stabilize the long end. Then, if that's not enough, you potentially get a policy ceiling on yields. And if that ceiling has to be defended aggressively, that's when the balance sheet can explode. That's the part I don't think the market's pricing correctly, because the Treasury buyback itself isn't a massive liquidity event. It's the signal that authorities are beginning to acknowledge the problem. The real liquidity event would come later if they are forced to defend the market directly. And that's why I keep saying things may have to get worse first, because policymakers don't jump in immediately to the most extreme tool. You don't kill a fly with a sledgehammer. They usually escalate. And we'll potentially watch the beginning of that escalation right now. You don't necessarily go straight from a Treasury buyback announcement to massive QE. The market gets to test the authorities. Yields get another opportunity to rise. Financial conditions tighten. Credit starts feeling the pressure. Equities start wobbling. And eventually, if something breaks badly enough, that's when policymakers have a reason to pull the lever. And if we eventually get that outright Fed purchases, and that's a completely different environment, because now you're talking about the creation of new reserves. You're talking about balance sheet expansion. You're talking about the Fed absorbing duration, and you're potentially talking about a significant easing of financial conditions. And historically, when liquidity comes back into the system, you don't necessarily see all of that money sitting in treasuries. You can see capital moving further and further out on the risk curve. Stocks, credit, commodities, gold, and potentially crypto. That's why I keep coming back to Bitcoin and gold as potential pressure release valves. When confidence in traditional rates mechanism starts getting challenged, capital starts looking for somewhere else to go. Now, I don't think that means everything goes straight up from here, ladies and gentlemen. Actually, the opposite could happen first. And that's where things get uncomfortable. We're already seeing degrossing. We're seeing momentum trades unwind. We're seeing defensive sectors showing leadership. We're seeing investors reduce risk. We're seeing hedging demand return. That's important, because when rates start moving violently, eventually the equity market has to pay attention. You can ignore rates for a while. You can't ignore them forever. And that's exactly what we're beginning to see. The interesting question is whether this turns into another major risk reduction event, or whether the market absorbs this rate shock and then turns higher again. Because remember what happens when positions get washed out. You can create the conditions for a very violent upside move. If enough investors are forced out of positions, if enough leverage gets removed, if enough hedges are put on, then suddenly you don't need a huge amount of good news to create a squeeze higher. And that's why the next big catalyst is so important. Because if rates markets stabilizes and we get strong AI earnings on guidance, suddenly you've got a completely different narrative. AI acceleration, tech leadership, short covering, risk coming back into the market, and potentially a situation where everybody who just got scared out of the market has to chase back it up. And that's the setup I'm watching. But don't miss the bigger picture. The Treasury buyback isn't the end of the story, ladies and gentlemen. It's the beginning of a conversation. It's an acknowledgement that the long end is becoming a problem. And the longer term problem is much bigger than one Treasury announcement. You've got government deficits. You've got massive debt issuance. You've got corporations issuing debt. You've got AI investment requiring enormous amounts of capital. You've got geopolitical fragmentation. You've got countries reassuring supply chains. You've got governments trying to secure critical resources. You've got energy independence becoming a national security issue. And all of that creates a world where inflation may structurally harder to kill. So the authorities are caught in a trap. If they keep rates too high, they risk breaking the economy. If they cut too aggressively while inflation remains sticky, they risk reigniting inflation. And if the long end blows out because investors demand more compensation to hold the government debt, suddenly monetary policy itself becomes constrained. That's the real problem. And that's why I think the next phase of this market is going to be fascinating, because the question isn't simply, are rates going up or down? The question is, at what point does the government decide that the market forces have had it far enough? And I don't think we're necessarily there yet. In fact, I think there's a very real possibility that things have to get substantially worse before we see the real aggressive response. That's the irony. The intervention everyone is waiting for may eventually happen, but the market may have something to break first to force their hand. So I'm watching the sequence. I'm watching treasury yields. I'm watching the dollar. I'm watching gold. I'm watching Bitcoin. I'm watching credit spreads. I'm watching volatility. And then most importantly, I'm watching what happens when financial conditions become too tight for policymakers to tolerate, because that's when the story changes. And here's the part I want you to remember. This treasury buyback is not the bazooka. No, it's the warning shot. It's treasury saying we're paying attention. But if the market keeps pushing, if yields keep climbing, if inflation keeps getting worse, if energy shock intensifies, financial conditions tighten enough, then eventually the question becomes, what's the next lever? And that's where this gets really interesting, because that bazooka baby may eventually come. But first, things may have to get a lot worse. And if that happens, I don't think you want to be looking at this market through the lens of just stocks and bonds. You want to be watching where the liquidity goes, because when the authorities finally have to choose between protecting the long and protecting the economy, that choice may define the next major move across gold, Bitcoin, equities, and the entire risk curve. And that is the part of the story I'm watching very closely. Ladies and gentlemen, you have to understand something. None of this is financial advice, just my own opinion and retention any capacity. Always consult a licensed financial advisor. Never invest a single dollar, ever, for watching a YouTube video. This is part 2 of the carnivorous rant. That's all you need to understand right now. If you want to know how to prosper from this and take advantage of everything I just said, and you want a position before the next move happens, and you want to see the financial instruments to be involved, the stocks, the price levels, everything, come and join the Crypto Public Desk monthly, ladies and gentlemen. Join over 680 active traded investors who are taking their own destiny into their own hands. One tip from the pit pays for everything, your entire year subscription. Most people now are asking how high will it go instead of the desperation of it's crashing and burning. You should transcribe this video and 2 days ago video. It tells you everything you need to know. It tells you why we understand what's happening next. See, when we, in my career in our organization, when we have dialed in of what's happening, like why I told you that they're going to crush our Indian currency, what's happening and why. Once we have enough things on all boards checked off that we're right, the positions we're watching, we know are right, ladies and gentlemen. And I'm not going to give that away for free. If you want to know what those are, come and join the Crypto Public Desk monthly. Don't get caught up like sushi. Don't FOMO things here. Wait for the proper levels. That's it. We are the financial mercenaries for a reason, and we are the remora for a reason. But don't get caught up like sushi, ladies and gentlemen. Don't give away your ticket to the blockchain bonanza. Don't do it. I love you all, ladies and gentlemen. I'm going to see you on the front lines.